Hi, this is Doug Porter, Chief Economist with BMO Capital Markets. Well, probably the most important development in the economic world in the last couple months has been the big backup in long-term interest rates. Now, it's been led by what's gone on in the U.S., but it certainly hasn't been confined to the U.S. as we've seen global long-term interest rates shoot higher since early May. Just to pick one example, the 10-year Treasury yield in the U.S. is up by about 100 basis points from its early May low. So back in early May, it got down to as low as just a little bit more than 1.5%, and now it's above 2.5%. There's no mystery as to what's driven this sharp backup in yields. It basically was driven by a series of comments and events from the Fed and Chairman Ben Bernanke that indicated that the Fed is now soon considering tapering quantitative easing. And we do believe that the Fed will indeed announce in September that they will start to reel back QE3 and that they will end it by the middle part of 2014. But we think the market reaction is far overdone, and we suspect that long-term interest rates really will not rise much further this year. We do suspect that they'll rise a little bit further in 2014, but nothing on the order of what we've seen in the last couple months. Now, a few reasons to believe that the sell-off in bond yields is a little bit ahead of itself and is a bit overdone. One, U.S. inflation remains barely above 1%. Second, the global economy continues to see very lackluster growth, and that's most notable in some of the emerging markets now, which have clearly slowed almost across the board. Third, the reality is there's been no change in what the Fed will do with its short-term interest rates. It's still locked basically at zero, and we see it remaining there until the middle part of 2015. And finally, quietly behind the scenes, the U.S. budgetary situation has improved immensely. In the last year alone, we've actually seen the U.S. budget deficit come down by more than $400 billion. The U.S. budget deficit is actually about half of where it was as recently as 4 years ago. So all those reasons lead us to believe that the backup in interest rates from here on out will be nothing close to as dramatic as what we've seen in the last couple months. Now, here in Canada, our long-term interest rates have also risen. That's been a problem for certainly any interest-sensitive sectors of the equity market. The backup here hasn't been quite as severe in the U.S., but it's also been very important. Importantly, in Canada, we also do not see any major change in the Bank of Canada policy. The first meeting under the new governor, Stephen Poloz, will be on July the 17th. We think at that point they will signal a continuation of the policy as it was under Mr. Carney. We don't see the Bank of Canada moving on interest rates until the middle part of 2014. And even at that time, we think that the rate hikes in Canada will be very, very modest over the next couple years. So that's the major economic message for the past month. Thank you very much.